For 7 years, a mid-size manufacturing company in Ohio paid a vendor that did not exist. Not a vendor that underdelivered. Not a vendor that overcharged. A vendor that had no employees, no physical location, no equipment, and no operational capacity of any kind. The payments went out every month. The invoices came in every month. The annual audits reviewed the accounts every year. Nobody flagged it. Total paid to a non-existent vendor over 7 years, $2.3 million. This is the full breakdown of how the scheme was constructed, why it survived 7 annual audits, and what finally exposed it. The company, we will call it Hartwell Manufacturing, produced industrial components for the automotive sector. Founded in 1987, it had grown to approximately 220 employees by the time the scheme began in 2009. The individual who constructed the scheme was not the CFO, not the controller, not anyone in senior financial management. It was the accounts payable coordinator, a mid-level employee whose primary responsibility was processing vendor invoices and initiating payment requests. That position, accounts payable coordinator, sits at one of the most consequential points in any company's financial architecture. It is the person who decides which invoices get paid, when they get paid, and to whom. In most small to mid-size companies, that position operates with limited oversight. Invoice comes in. Invoice gets coded. Payment gets initiated. The volume is high enough that individual transactions rarely receive careful scrutiny. That environment is where this scheme lived. The coordinator, we will call her Sandra, began the scheme in January 2009. She registered a limited liability company in her cousin's name in a neighboring state. The LLC had a legitimate registration number, a bank account, and a business address at a commercial mailbox service. She added the LLC to Hartwell's approved vendor list using her own system access. The vendor was listed as a maintenance and facility services provider, a category broad enough that invoices for cleaning, repairs, and general upkeep would not raise questions. The first invoice was for $3,200, described as quarterly facility maintenance. It was processed and paid within the standard payment cycle. Over the following 7 years, Sandra submitted 847 invoices from the fictitious vendor. The amounts ranged from $2,800 to $8,400. Never consistent enough to establish a pattern. Never large enough to trigger the secondary approval threshold of $10,000 per invoice. The payments went to the LLC bank account. Sandra transferred them from there to personal accounts in irregular intervals, further obscuring the trail. Now the question every audit should have answered: why did 7 years of annual reviews not catch this? The answer is in how the audits were structured. Hartwell's annual audits were conducted by the same regional accounting firm for all 7 years. The audits were financial statement audits, designed to verify that the company's reported financials accurately reflected its financial position. A financial statement audit is not a fraud investigation. It is not designed to detect vendor fabrication. Its purpose is to confirm that the numbers in the financial statements are accurately recorded, not to verify that every vendor in the accounts payable system is legitimate. The fictitious vendor's payments were accurately recorded. Every invoice was coded correctly. Every payment was reflected in the accounts payable ledger. From a financial statement perspective, the records were clean. What the audits never did was verify vendor legitimacy independently. They never cross-referenced the approved vendor list against external business registries. They never confirmed that the services described in the invoices had actually been performed. They never checked whether any vendor in the system shared ownership or banking details with an employee. Those procedures, vendor verification, service confirmation, conflict of interest checks, are part of a forensic audit or an internal controls review. They were not part of Hartwell's annual audit scope. Sandra understood this distinction. She had processed invoices through enough audit cycles to know exactly what the auditors looked at and what they did not. What finally exposed the scheme had nothing to do with the audits. In 2016, Hartwell Manufacturing was approached by a larger competitor interested in acquisition. As part of the acquisition due diligence, the acquiring company hired a forensic accounting firm to conduct an independent review of Hartwell's financial records. The forensic accountants began with a vendor verification exercise, cross-referencing every vendor in the accounts payable system against state business registries, confirming physical addresses, and checking for any ownership connections to current or former employees. The fictitious vendor failed the first check. The commercial mailbox address did not match any legitimate business operation. The LLC's registered owner, Sandra's cousin, had no documented relationship with Hartwell Manufacturing. The forensic team pulled the full payment history. 847 invoices. $2.3 million. 7 years. Sandra was terminated immediately upon discovery. Criminal charges were filed within 30 days. She was convicted on 12 counts of wire fraud and sentenced to 4 years federal. Full restitution was ordered. The acquisition did not proceed. The acquiring company withdrew upon receiving the forensic report. Hartwell Manufacturing was sold 18 months later at a significantly reduced valuation. 3 internal control failures made this scheme possible. Failure 1. No vendor verification process. Any employee with system access could add a vendor to the approved list without independent confirmation of legitimacy. A basic vendor onboarding process, requiring documentation, physical address verification, and management approval, would have prevented the fictitious vendor from entering the system. Failure 2. No conflict of interest screening. Employees with payment authority were never required to disclose ownership interests in vendors doing business with the company. A simple annual disclosure form, standard in most compliance programs, creates a documented record that deters this category of fraud entirely. Failure 3. Scope mismatch between audit type and fraud risk. Financial statement audits do not detect vendor fraud. Companies that rely solely on annual financial audits for fraud prevention have a significant gap in their internal controls. Periodic internal controls reviews, conducted independently of the financial statement audit, are specifically designed to identify the conditions that enable occupational fraud. The Association of Certified Fraud Examiners estimates that vendor fraud accounts for approximately 18% of all occupational fraud cases, with a median loss of $200,000 per case. The cases that reach 7 figures, like this one, share a common profile: a trusted employee, limited oversight, and an audit process that was never designed to find what was there. Sandra did not hack anything. She did not forge signatures. She did not access systems she was not authorized to use. She used the access she was given, in the role she was trusted with, within a system that had no mechanism to check whether she was abusing it. That is not a story about a dishonest employee. It is a story about an organizational structure that made dishonesty easy and detection nearly impossible. In the next video, we break down how operating agreements determine what happens to a company when a partner exits, voluntarily or otherwise. Most agreements are silent on the question that matters most. This is verdict paper. Every collapse has a paper trail.